Okay, we'll go ahead and get started. First of all, by way of introduction, my name is Paul Humes. I am currently the Chief Financial Officer for the National Groundwater Association. I've been with the association for a little over 17 years, been in the accounting profession, I hate to say, but more than 35 years. In doing this kind of presentation, I've been analyzing and creating financial statements and deeply involved in it, and there's a lot of things that just seem elementary or second nature, and I get a little concerned about either talking too high of a level for the listener or being too elementary. So as we start with the presentation, if it's either too elementary or too high level, then I'd like you to interrupt me. Feel free to ask questions as we go along. I'm more of an interactive presenter than just stand up here and lecture for however long this is going to take. Anytime you're dealing with financial statements, I always start with the basics. And the basics, there are basic financial statements. An income statement, obviously, most of you business people are probably familiar with an income statement, commonly called a profit and loss statement, the balance sheet. Balance sheet, again, is actually intricately linked with the income statement, and I'll get into that a little bit more. But the balance sheet represents the assets, liabilities, and net worth. What I have, what I owe, and what is mine. Statement of cash flow, I'm not going to talk a lot about it, but as we get into analyzing financial statements, cash flow is different than net profit. The fundamental foundation of accounting is the accounting equation. And that accounting equation is assets, what you have, equals your liabilities, what you owe, and your net worth, what is yours at the end. Net worth, further broken down, is the amount of capital you've invested in your business plus the cumulative profit or loss. Okay? I hope that makes sense. You can't analyze the P&L without also analyzing the balance sheet. And let me give you an example. If you look at a profit and loss statement and it shows sales of $100,000, and that's all you look at, and you assume that you or the company that's representing $100,000 in sales is doing fairly well. If you flip over to the balance sheet and you see $100,000 in accounts receivable, what do you have? You've got promises to pay. You haven't collected that money. You have to question the validity of the sale itself, of the sales presentation itself. So again, you can't look at the income statement without also looking at the balance sheet. And we'll get into this again a little more as we go along. If I go too fast, slow me down. Again, I make a lot of assumptions. The first thing you want to ask about a profit and loss statement is it a cash basis statement or is it an accrual basis statement? Very simply, a cash basis profit and loss statement records the revenue and expenses only when cash is received or expended. So you don't record a sale until you receive the cash. You don't record the expense until you pay the invoice. You could have a sale today and not receive that money for 90 days, and you don't record that sale until you've received the cash. Same on the expenses. You may have expenses that you've purchased from a supplier, and the supplier is giving you 30 days to pay the bill. You're not recording that expense until you actually write the check. It's pretty simple, just like your checkbook. You know, my checkbook, I don't record cash in my checkbook until I receive the cash. I don't record the expenses until I write a check. Very simple. I know how much my cash balance is, but if I'm a business, I don't know what my revenue and expense is at any point in time. I just know my cash balance. And on an accrual basis, revenue and expenses are recorded when incurred, not when the cash is received or expended. So if I have a sale, have a contract, well installation, pump installation, maintenance, whatever it is, at the point that that job is complete, the customer is signed off on the work, that's a sale. I'm done. I record that as a sale. Could also be, would sometimes likely be also recorded as an accounts receivable unless he's paid at the point of signing the contract. But it's not a sale. It's recorded as a sale when the work is completed, accepted by the customer, whether the customer has paid or is paying or will pay in the future. The same way with expenses. I may buy pumps and piping and wire and cable and whatever else goes into drilling a well or servicing a well. But I'm not recording that as an expense until I actually use it for a job that's producing revenue. So I may record it as an inventory item. I may record it as a capital expenditure in the case of a large purchase like a drill rig. We'll get into depreciation in a second. But that expense isn't recorded until that product is used to generate a sale. So what you've got is you've got linkage, direct linkage between the work performed and the specific expenses associated with that work performed. So you're matching revenue and you're matching the expenses incurred to generate that revenue. That is by far the preferred method for a number of reasons. Job costing for one reason. You can tell the profitability of the job because you've matched the revenue and you've matched the expenses directly related to creating that revenue. Does that make sense? There are some pros and cons to cash basis. First of all, it's easy. You know, like your checkbook, it's very easy. Cash comes in, I write it down. Cash goes out, I write it down. I add it up. I know what my cash balance is. The mistake I've seen people make is I'm profitable as long as my cash balance, my cash account is positive. If my bank account is positive, I'm profitable. You could be fooling yourself. You're likely fooling yourself because you may have expenses, you may have purchases that you haven't paid for, you may have revenue that you haven't received payment for. You know your cash balance, and that's all you know. You don't know if you're profitable or not. You can't tell the amount of accounts receivable outstanding. Again, I get back to linking the balance sheet with the income statement. Recently there was, well, not recent, it's not uncommon in financial statement manipulation at all levels of businesses and facilitation of embezzlement for people to record sales that are non-existent, record them as a sale, record the accounts receivable on the balance sheet, and the amount of accounts receivable equals the amount of the sale. If the sale is fictitious, obviously you're not going to collect that cash because it's not real. But if you just look at the income statement, they may show a profitable income statement.
What method is that?
This is using cash basis, which is not the preferred method. A lot of small businesses still use cash basis. I highly recommend not doing it if you're doing it. So, again, this is, or if you have an accountant that does it, or if you have an administrative office person that does it, and they're using cash basis, you need to be very suspicious. Not that they're bad people. I'm not, casting dispersions at all. But it's very easy to manipulate unless you link the balance sheet with the profit and loss statement. If your accountant or your employee is providing you with just a profit and loss statement, you possibly have some significant issues, and I would highly recommend investigating that. Bad debt experience, again, if you're carrying accounts receivable, in all likelihood you have bad debt, some level of bad debt. And if you're on a cash basis, you just have no idea what that is, or you can't estimate it. It's just it's just harder to do, or because it's not cash coming in or out. Bad debt doesn't exist, so your accounts receivable is likely overstated. Even if it's real, it's likely overstated because everybody knows some people don't pay the whole bill, some people go bankrupt, some people disappear. So you have, again, an overstated revenue and an overstated receivables. Cash basis misallocates cost because expenses are recognized when they're paid, not incurred. Depreciation expense is another example. If you're on a cash basis and you're purchasing capital equipment, it could be as big as a drill rig. It could be anything above a certain threshold that has a useful life of more than 1 year. That's a capital expenditure. And if you expense that capital expenditure in the year of purchase, you've overstated your expenses. You've understated your profit, because the utilization of that capital equipment is going to be spread across multiple jobs over time. Inventory and supply purchases are not linked to use. If you're buying all those supplies in bulk, and you've got a warehouse with, again, whatever drilling supplies are necessary, casing and nuts and bolts and ties and all that variety of stuff. If you just purchase that in bulk and expense it at the same time, then you've overstated your expense, you've understated your net profit. This really gets important when it gets to job estimation and job costing. Because when you go out to do a job and you haven't accounted for expenses already paid, like depreciation on equipment, like inventory and supply purchases, because in your mind, I've already paid for that. That's gone. I've already expensed it. I grab it off the shelf, and I don't account for it in my job profitability. So if I'm doing a $10,000 job and I'm not adding these expenses to that job, the job profitability is misstated. So you go out to bid and you're looking at previous jobs, and this $10,000 job cost me $5,000 to do because I didn't account. Let me go back here. Because I didn't account for depreciation or inventory and supplies, then I've underpriced that job because I've accounted for the expenses necessary to do that job. Yes, sir.
So, how does that work? So if you got a drill bit, and some job you don't know whether, that bit might last you 5 jobs, but you don't know whether it's going to last you 1,000 feet or 2,000 feet.
Mm-hmm.
So, before that bit's used up, how do you know what your real expenses are?
The art and science of depreciation is you estimate either by feet or by number of jobs that you think that bit is going to be utilized. So if you say this bit will last 10,000 feet, then you take the cost of that bit, divide it by 10,000 feet, and that's the depreciation, that's the expense applied to the job for the use of that bit. Now, because you're estimating, you could be wrong. And when you're wrong, then a job gets over-expensed. Depreciation, it's an estimate. But again, at least, even though it may be imprecise, at least each job that you do while using that bit gets charged some portion of the wear and tear associated with that bit. So if I don't factor that into my cost structure or my bid, if I miss that completely and say I already bought the bit, then the wear and tear, ultimately the bit, is not usable. I've got to go out and buy another bit, but you haven't accounted for, or you haven't priced into a job the utilization of the first bit. Does that make sense? Beg your pardon? It is a best guess. You do it with automobiles. You think an automobile is going to last three years, or a vehicle, a drill rig. You're going to estimate the residual value or the trade-in value at some future period in time, and then you're going to depreciate the remaining value while you're using that rig. You're going to charge that depreciation as part of the job as it's being used. At the end of 15 years, you may have either overestimated or underestimated the trade-in value of that vehicle. Then you take either a gain or a loss on the disposal. Okay, but you've reasonably charged each job the wear and tear of that vehicle over its useful life. again, that gets down to, obviously, it's hard to determine job cost, and that's basically all that we've just gone over. Accrual basis, it has some pros and cons. The pros, it links together revenue and expense incurred to generate that expense. So you know exactly what it cost me to do a job. If I've accounted for those supplies, if I've accounted for that labor, if I've accounted for depreciation, I factored that all into the job, I know whether my job itself is profitable or not. And if you find you've got job profitability issues, you know where you can hone in on those, because you know by job what your cost structure is, what you sold it for. If you're carrying accounts receivable, you have to factor in some bad debt factor, whether it's 5%, 10%, 2%. Again, that's one of those estimates that are used in accounting. So you go back and bid on another job, you look at a similar job sheet that you've performed, an actual job costed, completed, and that should help you bid more accurately on future jobs, because you've linked all of the cost to that particular type of job. So you can go to the customer and present, again, a reasonable, for you and for the customer, a reasonable bid, because you've captured all those costs. The cost of capital expenditures are spread over the useful life of that equipment. Again, we just talked about that, is a drill rig, a truck. The use of those items are over many years, over many jobs, and each job should bear some burden of that cost, and that's called depreciation.
So I have a little follow-up question with that. On things like that, or maybe something that you don't really, maybe in the beginning, have any idea of, how many jobs it's going to do, or how long it's going to last. And maybe you don't know that for an extended period of time. How are you supposed to estimate?
Estimate it based on your experience with other types of equipment. Talk to people in a similar industry with similar equipment and ask them how long do they depreciate their equipment. And it's a best guess. There's no science to it. There's no formula. Excuse me. There are IRS guidelines on depreciable equipment. So the first thing I would do is go to the IRS guidelines and say, and see what they may not be as specific as having a drill rig, for instance, but construction equipment, and they recommend a useful life. Now, you can use alternate useful lives if you've got a sound basis upon which you're using a useful life that's different than the one recommended. But it's a guess, hopefully an educated guess. And the reality is you will probably either overestimate or underestimate. And at the end of the useful life, and you dispose of that equipment, you will take either a loss, a gain or a loss on the disposal or trade-in of that value. If you're trading it in, you'll add that loss or gain to the value of the new vehicle, and that will be its depreciable basis. And again, your estimate of whether it's number of feet or number of miles or number of jobs or number of years, it's your best guess. Again, I talked about it's easier. Jeez, I can't figure this out. It's easier to allocate and apply expenses to specific jobs. This is really important, again, in inventory. You know, you buy a bunch of inventory, you pay $10,000 to stock your shelves, and, you know, you forget when you pull things off the shelf and take them to the job, I've got to charge this to the customer. This makes it easier to do that. One of the negatives is you do need to reconcile your accrual basis reports to your checking account. Again, revenue minus expenses equals profit does not equal checking account balance. Okay, so we're talking two entirely different things. Profitability does not equal cash balance. Typical profit and loss statements, there are minimum requirements on profit and loss statements. If you deal with bankers, deal with lenders, those are probably the two areas that you would be presenting financial statements or showing, or borrowing money. They want to see financial statements. There are some basic there's some basic requirements. Revenue. You've got to show revenue. Could be just one line item. You have to show operating expenses. That could be just one line item. You have to show operating profit, which is your revenue minus the cost necessary to produce that revenue. That cost excludes overhead, rent, electricity, administrative staff salaries. That's the profit, that's the expenses necessary to produce that revenue, and that's your operating profit. So my operations generated $100,000 in revenue. My expenses to generate that were $80,000. I've got an operating profit of $20,000.
You said that they should not include, the operating expense should not include, your management and secretarial expenses?
Correct. Now, if your office person is out working on a job also, you should charge that person's time to the job, because that person is directly involved in the generation of that revenue. But if you've got an office manager that sits in the office, customer service, takes the phone, writes up orders, that's not part of generating that revenue by definition. Okay? Yes, sir.
Is there really anything standard on a P&L statement for the period of time that you're looking at, whether it be 1 month, 6 months, a year, 5 years? In our time,
There is not. At the minimum, and again, this is the minimum, and I'm going to go into the value of a minimum, the value of adding on other components within the financial statement. So I'll get to that answer here as we proceed. Again, the profit and loss statement, we've got operating revenue, operating profit, direct revenue or revenue generated, the direct expense of generating that revenue. We've got operating profit. From operating profit, we account for the selling, general, and administrative expense. You can do it, again, minimum one line item, general, administrative expense, one line item. That produces net income. So that's your net income. Multiple periods presented is required. I'm sorry, I didn't think it was, but it is required. You're required to present at least 1 year comparative. So you've got 2012, and this is a very basic, and I'll show the statement here in a second, very basic, 5 or 6 lines, 2012, comparative 2011, and that's it. That's minimum. Nothing more required.
Minimum for what? For reporting
A minimum from the accounting pronouncement people. Your banker, for instance, first of all, you may be happy with this. This may tell you everything you want to know. I don't think it should. But if you go to a bank, this is the minimum expectation. Okay? I'm not saying minimum is good. Before I show financial statements, the various types, and get into some more details, on analyzing financial statements, whether it be your own or someone else's, the first key question is what did I expect? You know, I'm running the business, I'm involved in the business, I may not see all the invoices or all the payments or all the supplies coming in and out. I may not see all the sales, but I have a general expectation based on my involvement in the business. So what did I expect? Did I expect to see sales increasing or decreasing? You know, it's a bad economy. Normal expectation is, I think our sales are down. So that's my expectation. I've been doing more maintenance work. Fewer pump installations, fewer drilling jobs. So my expectation is my sales mix has changed. Did I expect to see particular expense ranges? You know, I know my basic salary. I know how much I pay people. I should have an estimate of my depreciation. I should have some idea of my operating expenses. Job costing, you know, I know of a $10,000 job generally costs, $7,000. Those things you just intuitively know by being involved in the business. Did I expect a certain level of profitability? Did I expect, based on everything else that I know, to see $10,000 in profit or $5,000 less than I did last year? So it's all mental. I'm sitting down with a financial statement that, someone prepared or I'm looking at, and knowing the business, you have to factor in, what did I expect? And then when you start looking at the statement itself, the second question is a big question: why? Why did sales increase or decrease? Again, intuitively you may know that. Why is the sales mix different? Why are selling expenses higher? Why did expenses go up or down? We didn't change anything. If my salary expense went up by $5,000, and my payroll person also does my financial statements, and that's not an unusual situation. You could have a rogue problem within your operation and not know it. You're going to look at sales and expense trends consistent year to year. You know what you've done the last 4, 5, 6 years. Is it consistent? Is it consistent in context of the economy, in context of everything else that's going on in the world right now? Is it consistent in the sales mix, which would provide different variable levels of profitability? But if there's inconsistency, is it the type of inconsistency I expected? And the only way to do that is compare that to previous periods. If you can get it, are my trends consistent with competitors' experience? You know, we're at a national convention, and we have antitrust considerations that we have to be very careful of. We can't talk about pricing. We can't talk about fixing territories. We can't talk about boycotting. We can't talk about a number. If you're not familiar with some of the antitrust regulations, you've got to be careful about what you can share with your competitors or your peers. But you can talk to your competitors about, you know, what's their business like. You know, what are you seeing a change in mix? Are you seeing a change in pricing? You can ask about general pricing. You know, is your market able to absorb higher prices? Have you had to cut prices in order to get jobs? You can talk about those general terms and get an idea from your competitors that gives you, again, a frame of reference on analyzing either yours or someone else's financial statements. I'm going to skip this one. It's too busy. This is the basic financial statement that I talked about, bare minimum. I don't know if you can read this, but again, we've got, can't teach an old dog new tricks. You got one line for total sales. You know, that tells you something. Sales went up. Did I expect that? You know, again, what were my expectations? Operating expenses went up. Well, that kind of makes sense. Income from operations went up. Well, that kind of makes sense. You know, all that's good. My sales expense went up. Well, yeah, I guess because that went up, my salespeople had to work harder, and, you know, that seems okay. You know, I'm happy with that. General and administrative costs stayed about even, so, you know, I didn't add any general sales and administrative expenses. Seems okay. Total non-operating expenses, again, that's the sum of these two numbers. They went up a little bit, but that's in sales. So that's okay, I'm fine. Real happy. Man, I made more money. I'm thrilled to death. I got more revenue and more profit. You go away happy. I recommend you don't go away happy. I apologize, I don't know if you can see this, but this is taking that summary and expanding it. My sales went up. My sales went up from 52 to 56. But now I know where they went up and where they went down, if they went down. You know, I had more drilling operations, and, you know, I'm not a well driller, so, you know, my representation here is, you know, coming from that perspective. But I drilled more. Pump installations went down. Would that seem odd? Might seem odd. My service, sorry for the shaky hand too. My service work went up. Well, that makes sense. You know, or does it? I don't know. What did I expect? Product sales, ancillary products, people come in and buy stuff, stayed the same, so we didn't sell any more or less than we did in the previous year. So this gives me some information that I didn't have in the basic financial statement. My operating expenses, they went up by $2,000 approximately. Salary and wages. Well, I drilled more. I did a little more service work, so I had to probably pay a little more. Benefits went up a little. Insurance went up for some reason, probably just a rate increase. Operating supplies went up a little bit. Again, that may make sense in light of I did more service and I did more drilling. So that may make sense. My depreciation is consistent. I didn't add any new equipment. That makes sense. Coming down to selling expense, my commissions went up, but my sales also went up. Again, is my commission plan fair and reasonable? Or if my salespeople worked harder, could they have gotten those numbers up higher? Again, those are questions that you would ask yourself and ultimately interrogate. General and administrative expenses stayed flat. I didn't change anything in my administration, the office. Everything stayed the same. I didn't expect any changes. I didn't add any facilities. I didn't need more insurance. I didn't need more people. I've got enough. I'm staffed and operating appropriately from a selling and administrative aspect. So that gives me the same numbers. But you've got more that you can investigate on. If I do something here, can I do something here? And can I manage this better relative to this to increase that number? So this is, and the more years you have, the better your perspective, and again, it gives you a trend. 2 years does not make a trend. So the more years you have, the better perspective you have on the value of these numbers. Again, this is probably a little hard to read, but it's all the same numbers here. Everything's the same. All we've added, part of this is for readability and analysis, but I've added percentages. So my sales went up 7.9%, 8%. My operating expenses went up a little over 8%. So it cost me more in operating expenses in percentage terms than it did in the generation of sales. So for $1 of sales, it cost me $1 something else, $1 plus. So my gross income from operations, went up 7.7%. Sales went up 7.9%. Operating or gross margin went up 7.6, 7.7. From my perspective, that's pretty good. I've almost got a 1-to-1 ratio of operating expenses, better than 1-to-1 ratio of operating expenses to revenue. So $1 revenue is returning me $1 plus in operating profit. Again, a trend, a multi-year trend, would tell you a lot more, because that 7.69 could have been 10.69 2 years ago. You could, if you see a declining trend, you need to analyze and give consideration as to what's contributing to that declining trend. I'm not pricing my jobs appropriately, or my operating expenses are out of control for whatever reason. But again, it opens up that opportunity to dig deeper into the operation and try to answer those questions. Sales expense went up 14%, but they only generated 8% in increased revenue. Again, that could be okay, but to me that's kind of a flag, is I paid more in sales expense in terms of percentages than the revenue increase percentage that I received. So again, it raises a flag to me. I would want to look into that. General and administrative expenses are unchanged. My net income is up 5.2%. So overall, I increased sales by almost 8%. Five percentage point of that came directly to my bottom line. So on this kind of situation, I would probably look at a couple things, look at my operating expenses. I would definitely look at my sales expenses. That may have a bearing on the mix of sales that they're engaged in. You may be paying commission. If you're paying commission, you may be paying the same level of commission on different value sales. 10% commission on a drill job and a 10% commission on selling something out of inventory. You may want to look at that and change that sales mix. So those are the things that I would look at. Again, it's easy to just take this at face value and say, well, my sales went up, most of that went to profit, everything's fine. And everything may be fine, but investigating and getting into 2 or 3 very focused areas could improve your profitability going forward. Again, these are all the same numbers. These are all the same numbers. All of this is the same. The things that I've highlighted are the percentage of, in this case, operating expenses to total revenue. So my operating expenses in 2011 were 38.5%. My operating expenses this year, 2012, are 39%. Again, it may make sense. I sold more. I had to pay more to sell that. But is that a good relationship? It may be these. The thing I really want to emphasize is the purpose of this is for you to ask questions of your organization and your business practices. And I'm not making any judgments on the right or wrong, but this is the information necessary to help you dig deeper into your operation. My gross income from operations, last year it was 61.5% of revenue. This year it's 61%, so it's gone down a little bit. Given that this went up a little bit, obviously this would go down a little bit. But this went up smaller than this went up. So, again, I could have put up 4 or 5 or 6 years, and that kind of trend will tell you more than just a 2-year trend. Sales expense went up 24% versus 21% last year. Again, a little more information. Your net income, 22%. 22% versus 22.6% of revenue. So even though it went up, net income went up, your net income, your net profit percentage went down. And it's almost counterintuitive. Revenue went up, but my net profit went down. I don't know how much time I have here. This was short. Any questions? I went through a lot of stuff, and it's a lot of it might be surface. A lot of it, hopefully prompted some ideas on your part. If you're not, or if you don't have someone preparing financial statements for you, I'd highly encourage you to do that. If you're not skilled at doing it, I would certainly hire someone that is skilled with doing it. The more information you have, the more insight you have into how you can manage and control your business to greater profitability. If you're looking at buying a company and they give you a basic income statement, I don't think you want to rely on that. But the more detailed, including adding percentage changes, looking at your overall business operations, this gives you an opportunity to pinpoint specific areas rather than just assuming and going off and trying to fix something that may not need fixed. This should highlight areas of concern, and again, it should generate a ton of questions, and then you get into dealing with your business operations, your financial operations, your accounting, your financial reporting, and the more information you have and the more skilled you are at analyzing it, would certainly facilitate your going in and talking to a lender or talking to a bank, because they know you know what you're doing. You've got financial statements that are multi-year. You've got trends that are multi-year. You can talk about depreciation. You can talk about job costing and how you job cost. You can price your jobs perhaps more appropriately or differently or better. If you've got commission salespeople, you can look at structuring their commission based on the sales mix. If the sales mix is changing over time, then you may want to alter sales commission programs to reflect the variability and effort to do that. That's all I've got. I'll take any questions or comments. Did you get what you expected out of this? Yes, sir.
I'll give a comment. A lot of this is pretty basic. Most of us probably, as business owners, if we can't do this, we're in trouble already. But I guess the big thing for me is, I think I have a pretty good pulse on where the company, where we're going to be by month on revenue. The big question is, every month, what are my expenses going to be? If you have multiple people, lots of purchase orders going out, so it's, your revenue's
Yes. Yeah, and that was my concern of being too basic, but also balancing that with not knowing the level of involvement each of you may have in this type of activity at your firm. I know, and again, even owners delegate some of this stuff, and they make some assumptions about the presentations that they're presented with, and again, there's opportunity for misrecording, not applying cost appropriately. We could get into budgeting. Budgeting, I'm sure you budget. I don't know if it's month by month or year by year, but those elements all figure in. Yes, sir.
You know what industry standard is on cost of overhead compared to revenue, or
Beg your pardon?
you know what industry standard is, what's your percentage of your expenses as overhead?
It depends on industry. I don't know. We haven't done a survey of drilling contractors for probably 20 years, so I don't know. Again, that would be a good question to ask your peers. What's your percentage of overhead, G&A?
National has done that for a reason for 20 years. I think it's been like 10 or 12, but they have, that is available nationally.
Yeah. Yeah, it's old, and it may have been 10 or 12, but I know it's been a while.
Well, and the world's a little different now than it was 10 or 12.
The world is different now, yes. Yeah. And the other thing, we've got an industry where spouses and family members, and even owners sometimes, don't take a salary, or they're they're paid a minimal amount. You've got to take that into consideration in I think pricing jobs. I think that if you've got a spouse that's working for free, part-time, doing the books, I think you should account for that spouse's time and charge it to a job. I mean, it's effort being expended for the business, and there's a monetary value associated with that. Sometimes, again, from what I hear, it's competitive to get jobs, so you cut cost wherever you can possibly cut cost in order to get a job. I understand having to do that, but your job costing itself, I think, is the key. And if you use this kind of information, the job costing really ultimately feeds into this financial reporting, and the financial reporting can feed into the job costing and give you a better handle on fairly pricing a product and being able to explain to your customer why your pricing is what it is. Yeah.
I think an important number in today's economy is everybody likes to keep their businesses running, and so an important number, if you cut the price so many dollars a foot, how truly does it affect? And we've had some seminars on that, and it doesn't take much to be real significant, and so the competition is underbidding you. You may just wave goodbye as they go out of business.
Mm-hmm.
Because there's got to be a point where you've got to analysis that of how low you can go before you're working for entertainment, or you can't replace your equipment, maintenance, or a year that you have additional expenses that you can't control. And a short period you can dip and come back up, but as long a period as we've had in my area downturn, boy, that's a very serious consideration.
And we do have job costing computer program. Again, I'm not a driller. I did use it just, you know, to get an understanding of, you know, some of the drilling terms and you know what goes into a job. But that cost calculator could be a very valuable tool because it makes you think about things that should go into the cost of a job that you might not think about. You know, maintenance. That's a very good point. If you're not costing in maintenance on your vehicles, and again, it's an estimate. I'm going to, you know, it's going to cost me $10,000 to maintain this vehicle this year. I'm going to do hopefully 100 jobs this year. So I'm going to charge X number of dollars for that anticipated maintenance. So again, that gets into the job costing part of it. But that's a very useful tool. If you haven't seen it, if you're a member, it's free. Just go on our website, ngwa.org,